Hello everyone, welcome back. Now, this may or may not be a bit surprising, but investing in the stock market will not make you rich, at least not quickly or easily. And in this video, I'm going to go over 3 of the main reasons why that is, and I'm also going to go over how to make it a little easier to accumulate wealth through investing. Now, reason number 1 why you're not going to get rich from the stock market: you do not start investing early enough. So research shows that those who start early allow their money time to compound more. However, research shows that just 39% of adults start saving for retirement in their 20s. So that is going to cause a significant impact toward that future compound growth. So let's do a little hypothetical chart here based on $100. If you start investing when you are 35 years old with this $100 and you don't contribute anything, we're going to say that the annual interest rate you get is 8%, which is pretty standard overall. And we're going to calculate that out. And you can see that that is going to give you a final balance of $1,000 roughly. Now let's compare that to the person that started investing at 25 and they're going to retire at 65, just like the person at 35 wanted to also retire at 65. And we're going to leave the interest rate the same at 8%. Now, the only difference here is the person that started in their 20s at 25 had 10 more years of time invested. And you're going to see how much of an impact that makes. They're going to more than double the final amount of money that they have versus that person that they were investing at 35. But this is a big problem because the research says half of adults between 18 and 34 are not saving for retirement at all. But that number kind of changes a bit, and 42% of adults aged 35 to 44 are saving for retirement. So again, the earlier you start, the better, and the earlier you start, it's going to make a huge impact on your final balance that you will have. So let's do a little test here. Leave a comment and let me know when you started investing. So now we're going to get into reason number 2 on why people can't accumulate wealth or get rich in the stock market. And that is because they don't save enough. Now, on average, savers typically save $985 a month on average. But the true median amount is reported to be $250. Now, that is going to be a little bit more realistic because the average is going to be skewed to the people that save a ton of money, while the median is going to be more a realistic number. So if you're going to be only saving $250 on average, you're really not going to have that impact of growth. Now, the good thing is, even with $250 a month, you still are going to come out on top of many other people. So here we have somebody that started investing at the age of 25 and they're going to retire at 65. And they're putting away $250 per month toward retirement and getting that 8% interest. And they are going to wind up with $777,000, which isn't a bad number, but that is far from being rich. Now we can compare that to the person that is very frugal or that earns a lot of income. You're going to see how big of a difference it makes. So we're going to do the same calculation, but instead of only contributing $250 a month, we're going to do $1,000 a month, and we're going to keep the time period the same and the interest rate the same. And we are going to see that you're going to wind up with $3.1 million, and that is over 4 times what the person that is contributing $250 a month will have. And by all standards, this is probably more so considered wealthy or rich by most people's standards. Now, this number is kind of skewed because unfortunately, research says that only about 45% of people would be able to cover a $1,000 emergency expense without turning to credit card or a loan, according to the survey. So in other words, they couldn't, if their car broke down or something, their car got a flat, they couldn't really cover that expense without having to put it on a credit card or going to get a loan. So even though that the median and average are significantly higher, there is a large number of people that couldn't even cover a $1,000 emergency expense. So let's do a test. Leave a like if you do invest more than the median person, which is $250 a month, and you'll be left with that $777,000 balance. And if you invest close to $1,000 a month, leave a comment saying so, and you'll be left with that $3.4 million balance. Now, this might be a little bit difficult, but one way to, of course, accumulate wealth is to earn more money. Unfortunately, many people don't earn the required wage to save that much money per month while they have their cost of living expenses to pay. So, of course, getting a better paying job or being able to save more money by being frugal is one way to earn more money and invest more money so you can really accumulate that wealth for retirement. Of course, that's a little bit easier said than done, and if that was easy, everyone would be doing it and everybody would be rich, but we just don't see that occurring. And finally, reason number 3 that people do not accumulate wealth is investing in the wrong things or a bad investment strategy. And this is, of course, many factors. It could be because of a lack of patience. So you see those ups and downs of the market, and you might see a 10% decline, and you lose your money initially, and then you sell out. So you're not patient. You don't have time to let that investment grow. So, of course, jumping into that, you have too much investment turnover. And this article here on Investopedia really goes over some great things that people should avoid. So jumping in and out of positions is another return killer. People shouldn't really do that. People should just buy and hold in a few simple ETFs, and ideally maybe even the S&P 500. People should not jump in and out of investments. So we also have attempting to time the market. People think that they can really time the market and say, okay, well, the market's going to fall, so then I'm going to invest then, and then I'll make more money by doing that. But what you'll see is no one is a pro at timing the market, really. The market may go up, it may go down. The best thing to do is just invest immediately while you have the money and then buy and hold. Remember, it is not going to work if you time the market. And failing to diversify. A lot of people might buy 1 or 2 things or 3 stocks or just a really concentrated investment like technology alone. And then they're not diversified. And then when the market turns against these positions, whether the stock does bad because the company doesn't perform well or because expectations of an industry shift, people are going to lose their money, and then that is going to waste time. And then when you do lose your money, you're going to let your emotions rule, and then you're going to sell out, and then you're going to, of course, lose your money. So that is going to have a huge impact on your investment. So if you start losing thousands of dollars in your 20s, remember, if you could have put that thousands of dollars into a S&P 500 fund and just held, that is going to cost you tens of thousands of dollars in hypothetical gains over that time. So really, don't time the market. Don't let your emotions rule. Don't buy and sell these various investments. It's just not a good way to invest, unfortunately, which I do see many people do, and then they wonder why they're not earning any money while they invest. So in conclusion, the sad truth about investing is that in the stock market, you will not likely get rich easily or quickly. Now, you can increase your chances if you start early, increase the amount of money you invest by earning more income or being frugal, or having a very simple investment strategy where you basically just invest in the S&P 500 or pick a very narrow group of ETFs to hold. So that is going to be it for today's video. If you did like this, comment, hit that like button, and subscribe for future content. And I will see you all in the next video.